Welcome back to another video. Soil here, and today I'm going to talk about leverage. We're going to see what leverage is and how it works, how to choose appropriate leverage ratio for trading, and what are the advantages and disadvantages of using leverage. Stay tuned and let's get started. Whether you're a beginner or an experienced trader, definitely you have already encountered the concept of leverage in one way or another. In the most basic definition, leverage is the amount of trading fund that your broker is willing to lend. So using leverage is actually the act of borrowing fund from your broker to trade or invest in an asset or market in the hope of making a larger profit. For example, by the help of leverage, you can trade on Apple stocks worth of $1,000 with only $200. You actually borrow $800 from your broker. Or in another example, you can trade on Bitcoin worth of $10,000 with only $1,000. You borrow $9,000 from your broker or exchange. So you can see that with leverage, you can get larger exposure to the market than the amount you deposited to your trading account. And this helps you to magnify your profits, but at the same time, magnifying your losses, which I'll explain more about this later. Now you may wonder how you can borrow. What's the limit? The total amount of leverage that you can use is not a constant figure, and it totally depends on your broker that how much leverage it provides for traders, and it may depend on the size of your trading account, the size of the position you want to open, your credit, the market and the asset that you want to trade, and some other factors. The amount of the leverage that is offered is most commonly represented as a ratio. For example, a leverage of 100 to 1 means that with $1 you can open a position up to $100. In other words, you can open positions up to 100 times greater than the amount that you deposited in your trading account. The leverage ratio is also shown like 5x, 20x, 100x, which is more commonly used in crypto market, and it has the same meaning. Now let me explain how this works. Leverage works by using a deposit, which is called margin. In fact, you put down a fraction of the full value of your trade, which is called margin, and your broker puts the rest. So the margin is the amount that you need to provide based on the leverage ratio that you choose. For example, with leverage ratio of 10 to 1, if you want to buy one Bitcoin at $30,000, you need to put $3,000 and your exchange or broker put the rest for you. So you can actually buy one Bitcoin worth of $30,000 with only $3,000. And please pay attention that although you're only paying a small percentage of the full value, both of your profit or loss will be calculated based on the full position size, not your margin amount that you put for the position. So if the market is moving in the favor of your position, you will enjoy magnified profit based on the full position size. But on the other hand, if the market is going against your position, you will suffer from a magnified loss too. Your loss will be calculated based on the full position size. That is why leverage is called double-edged sword, because it can have both of favorable and unfavorable consequences. Alright, now you may ask what leverage ratio is the best or how it should be chosen. Choosing a leverage ratio depends on many factors like balance of your account, the margin required, free margin that is available in your trading account, your account level, that some brokers may have different offers for different levels, and also other related concepts like margin call and stop out. It's highly recommended that you should never use maximum available leverage or high leverages, because those high leverages are for professionals to show flexibility when they need it. It's not for beginners and ordinary traders. You should always choose a conservative amount of leverage in the normal course of trading. Most of successful and profitable traders use leverages up to 5 to 1 at maximum, and they rarely go higher than this level, and on average they stay around 3 to 1. Leverage is an important risk factor in your trading that directly impacts your success. Actually, over leveraging is one of the most common reasons that beginners fail. Just look at this table to see how it affects your trading account. You can see that with leverage of 100 to 1, with only 1% change in the price of the asset, we will have 100% change in our trading account. If the price change is in our favor, we will have 100% profit, and if the price change is against our position, we will have 100% loss in our account. Actually, the account will go to zero with only 1% change in the price of the asset. Or with 50 to 1 leverage, with only 1% change in the price, we will have 50% change in our trading account. And you can see as we move to lower leverages, the risk also decreases. For example, for the leverage of 5 to 1, 1% change in the price will result 5% change in our account, or or for the leverage of 3 to 1, it will be 3%. And please pay attention that when you lose part of your account, gaining the required profit to cover your loss increases as the loss is higher. For example, in this table, you can see that for 10% loss from the starting balance, you need 11.11% to cover the loss. But as the loss increases, the required profit to cover the loss increases significantly. For example, for 50% loss, you need 100% profit to cover the loss. For 90% loss, you need 900% profit to cover the loss. Now you can see that if you lose considerable part of your trading account because of choosing high leverage, then the profit that you need to cover the loss and just to turn back to your starting point is very high, and it really demands hard work. So always maintain low levels of leverage, not more than 5 to 1 as I mentioned earlier, and choosing the leverage in this range depends on the condition of the market, the volatility of the asset, and the condition of the specific position that you're opening. As I said, most of successful and profitable traders rarely go higher than 5 to 1, and on average they stay around 3 to 1. Then you must always use stop loss to reduce the risk and protect your capital, because the market can go against your position no matter how master you are in technical analysis and trading. And you must set your stop loss as a part of a risk management strategy to properly deal with the risk. There is a risk management strategy that is called 1% rule. I have a complete guide on this. The link is also placed in the description of this video, and I highly recommend you to watch it because risk management is the most important factor for being successful in trading. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading.